Good afternoon, Jags. This is Fahad. Today is Friday, June 5th. It is a little after 3 o'clock Eastern Time right now, so we have just about an hour left until market close. So I wanted to make this quick podcast and just send it your way. We have been booking gains on a lot of positions all week long, and today was no different. So some of the trade ideas that we have closed, as I was saying all day in the chat room. So, for example, here is JP Morgan that was recommended in webinar, and we bought these calls for $4.30, and we closed them for more than $10 today. Here is Synaptics, same thing over here. I took this position off the table as well. For a nice 60-70% gain on these call options. Here's UPS that was recommended not too long ago as well in webinar a couple of weeks ago, and these calls had doubled this morning, so I closed them as well. Here's USCR. This was recommended just yesterday in webinar as well, and I closed them also today. And lastly, here's Zoetis, that was also recommended in webinar. This was about 2 weeks ago as well, and these calls have also more than doubled, so we took profit in that as well. Similarly, on the official trade idea side, if you take a look at that, we had the biotech position that I closed. Raytheon was another double for us. We closed position there. I also closed Micron. I also closed Lyft. I also, converted some of the other position, Alibaba and Anheuser-Busch. But all of these positions were nice wins, and I closed all of them in the last 2 to 3 days. Why am I getting into all of this? I'm getting into all of this because I want to go light on the bullish side going into the weekend. You see, let's take a look at the market internals over here. The S&P right now, after today's sharp rally after the job report came out, the RSI is now at 72. So the S&P is actually overbought in my view over here. But in itself, it may not be enough. So let's take a look at market internals. So here is NIMO that we always look at. Now, keep in mind these readings that I'm about to show, they're all as of market close yesterday. These charts will be updated tonight after market close with refreshed data, which will then be covered in the first read that will go out on Monday morning. NIMO closed at 80 yesterday, and according to Avo's calculation earlier in the chat room, the intraday reading for NIMO right now is 107, and that's just way too hot. It's Sahara Desert hot. And so that's where we're at. We're at 107, and I always say never fight NIMO. When NIMO gets way oversold, we get monster bounces back in the market. And when NIMO gets way overbought, we get some sell-off, some pressure on the market. So here we are. We're closing the week with NIMO at 107 as of right now. Let's see where it closes. So there's that. Similarly, if we look at NIMO summation index, which is NICE, if you take a close look at this, NICE is going to register about 860 or 870 level once this reading is updated tonight after market close. Now, what does this mean? This means that the previously, historically, looking at the last couple years, anytime when NICE is above 800, that's generally the spot we start to see some softness in the market. Some are rather harsh pullbacks, while others are rather just minor consolidation or nonetheless a few percentage point pullbacks in the S&P over the coming weeks. So you can see some of the prior examples over here. I've highlighted when NIMO has been, when we have had turning moments. Now, I don't look at NICE in a vacuum. I always look at NICE in relationship to its 8-day moving average. So if the black line crosses through the red line, that's when we know we have a breakdown. We have a turn-off moment that is coming. And it will not take a lot for that breakdown to happen. And so just keep in mind that NICE is going to close at overbought conditions as well, around 850. And previously, that has been the area where the market has struggled to continue to add on more gains. Similarly, if we go to this one, this is the percentage of stocks in the New York Stock Exchange that are trading above the 50-day moving average. Now, you guys remember back in March how oversold the market got, that literally only 2 to 3% of the entire New York Stock Exchange was maintaining its momentum above the 50-day moving average. Well, right now it's exact opposite, complete opposite of what we saw then. Right now, and this is once again reading as of Thursday market close, when it's updated tonight, you will see this thing is probably going to show about 95%. So 95, 96% of the entire market in New York Stock Exchange is trading above their 50-day moving average. The threshold that we've always highlighted is 80%. Whenever we are above 80%, that's generally when we have seen some loss of momentum. Sometimes it happens immediately. Sometimes it takes a couple of weeks. Nonetheless, you end up getting some sort of a pullback. And so you can see where the prior times we have reached those levels and we have seen subsequent pullback. So we are there right now in extremely overbought conditions based on this indicator. Similarly, if you look at the S&P 500 index, so the last chart was the entire New York Stock Exchange. But if you look at the S&P 500 index and do the same math there, what percentage of stocks are trading above their 50-day, you come up with the same exact conclusion. 96% of the entire S&P 500 index was trading above the 50-day. This reading is possibly about 98% after the market closes today. So very, very powerful momentums, and things are very, very good, but that's precisely when the tops are formed as well, and we start to get pullbacks in the market. It seems to me that we're at that juncture again. Again, these are the prior intervals. Just be mindful, like I keep saying, that sometimes the pullbacks are shallow and not very deep, but sometimes they're rather very, very dramatic. Nevertheless, some complacency has to come out and you end up getting some sort of a pullback. Similarly, and this is a very important reading that perhaps we don't spend enough time talking about, but this is the CBOE equity put over call ratio. And the red line that you're seeing is the 10-day moving average of the CBOE equity put over call ratio. All these charts are, by the way, provided in first read every day when it goes out. Now, when the red line, which is the 10-day moving average of the CBOE equity put over call ratio, comes down as much as it has, last Thursday or yesterday, it closed right at the 0.50 line, and today will probably be around 0.48 and such. This is extremely overbought conditions for the market. Basically, it's saying that for every one that there's simply not enough hedging going on. I mean, just to put it simply, what this data is showing is that in the looking at the equities market right now and looking at the option market, there's simply not enough hedges are being put on. That's what this indicator is showing. When you get the extreme level of hedging, the red line goes sharply higher, and that's when you know that when you have too many people hedged already, that's when the market tends to bottom, right? And when you have nobody hedging the positions, that's when volatile sell-offs can happen, and historically that has precisely been the case. So something to keep in mind as well. We are now at extremely low levels in this ratio and extremely high levels in the S&P as a result. So there's that. And then another one, the last one that I will show is the NAAIM Exposure Index. NAAIM is an organization that tallies up the sentiment from a lot of money managers. And in good, generally higher trending markets, in a bull market and a higher trending market, this index usually bounces back and forth between 55 and 95. And you can see that throughout in the year of 2019, that's how it goes up and down, up and down. This is one of the best contrarian indicators that are out there. So every time when this thing pulls back around 60 or less, that simply means that that the market has become a bit too bearish. That means a turnaround is coming. And when the indicator gets to 90 or 95 level, 95% that is, that simply means that too many bulls out there, and so market is overheating and a potential pullback could be in play. So literally you can layer this picture on top of S&P over here, and you can see how perfect technical indicator this is time and time again. Well, guess what? This reading is as of the chart that you're looking at is as of Wednesday this week on June 3rd. So at that time, this reading was already at 92%. And then considering what happened yesterday with more rally and then a powerful rally that is shaping up today, I think the next time when this reading is updated, you're going to see this thing at extreme level, possibly 97 and 98%. Basically saying that there are no bears out there. Everybody has piled into equities and everybody has gone bullish. And that's precisely the moment when the turns can happen. So keep an eye on this indicator as well. So my point is all of this, that, and by the way, one more last thing that I will just add to that. We often talk about SPY, and we look at the daily amount of call or put premium is bought in SPY. And we use that indicator to sort of gauge the sentiment, how the activity is taking place. And my threshold is always 25 million. If I see more than $25 million worth of put premium bought, then that generally gives us a sense that there is excessive amount of hedging going on in the S&P, which means a potential bottom in the market could be in play. Well, today it's extreme opposite. Today, right now, as I'm looking at my screen, approximately $37 million worth of call premium is accumulated in SPY today, well above my threshold of 25 million. And it's very rare to see the sizes, the numbers above 25 million. We're at $37 million worth of call premium bought in SPY today, basically telling me that there is panic buying going on, not panic selling. There's panic buying going on in the S&P in SPY call options today. So that's also something keep in mind. And this is happening with volume pretty strong as well. Call volume is running at 1.3 times daily average right now, and the share volume in the SPY is also pretty high, is going to be slightly better than daily average of 118 million shares in the S&P. So with all of this said, I just wanted to point out that we are quite stretched. Market internals, every single. I asked my team earlier, JIO Chronicle, is there any indicator that you can find me out there aside from the ones that we look at that is not registering extreme overbought conditions? And frankly, we cannot find any. That doesn't mean we're going to crash and burn, but that does mean that a few percentage points at some point, a few percentage point of pullback will not be a big surprise. So why not just go a little bit light going into the weekend? Next week is a new week. We will look at stocks new ways. We will look at markets and sectors and factor rotation from growth to value and all that fun stuff in new ways. And then we'll place bets indifferently, whatever basically is in front of us, and we'll trade it accordingly. But right now, going into the weekend, why not just be light a little bit if you're specially positioned with a very, very heavy long portfolio? That's all I wanted to say this evening, this afternoon before the market closes, to close out the week. That's it. See you in the chat room shortly.